Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I do each and every week, I've left my lines on the chart so that you can see the accuracy of technical analysis, particularly when it comes to analyzing the price using candle charts. So as I zoom in here, let me review what we talked about last week. Right here on this candle was the day I put it out, was last Friday, and I forecasted that we would move up early in the week and then pull back after the short rally and a test of this resistance area up here right around 215. And again, the evidence is right there, right before your eyes. You can see that the market did move up. Let me zoom in just a little bit more so you can see that. The market did move up on Monday. The markets were closed for the 4th of July on Tuesday, and then Wednesday we started to come back down. Thursday, we came within pennies of my low here, my target price right here. And so we're going to mark that as a win. A pullback below the 20-period moving average is what I forecasted. And now we're going to erase these lines right here, my forecast from last week, and I'm going to draw what I think we can see next week and right up until Friday, which is when the next report will go out. This two-day candle pattern is called a harami, and when you translate that from the Japanese interpretation of this candle, it means pregnant candle. And you can see here the smaller bodied green candle is falling within the larger body red candle, and so that is in the same category as a bullish engulfing pattern. So what I think we're going to see early on next week is a retest of this high, so I'm going to leave that as a resistance area right there, and I'm going to draw my forecast lines from here. So I think we're going to move up just a little bit, not a lot. I don't think we're going to break over this resistance point. But what I do think is going to happen after we rally up early next week is I think we're going to drop right back down to test this support level right here, right around 212.5 for the diamonds, which, by the way, the diamonds represent 1/100th of the Dow Jones Industrial Average. So if we're talking about a move down to the support level, we're talking about another maybe 100-point drop from where we are right now. So that's the forecast for the diamonds. One other point that I'd like to make is this drop in volume. When you see a drop in volume after the stock is pulled back a little bit, that tells us that the sellers are starting to weaken in their move lower. So that is also taken as a slightly bullish indication. And when you combine that volume with the harami, again, a short-term rally early in the week is what we're looking for. Now, if we look at the Russell 2000, which is a more broad-based index, I did something a little bit differently last week where I drew a zigzag pattern here, and I'll zoom in for you, where I said that early on we would move lower to bounce off of that 20-period moving average, which is that blue line right there. And again, remember, this is Friday when the forecast went out, and I said we would move lower. If you look at Wednesday's low, it moved right to my pivot point right there. Let me zoom in a little bit more so you can see this because it's quite amazing. It moved right to the pivot point that I drew, to the penny. And then on Thursday, we opened up higher, getting that bounce before going lower. So here's it's hard to see because it's hidden behind the candles, but this is what I drew last week. I said we'd go lower, move up a little bit, and come right back down. And the Russell 2000 hit my target right here perfectly. This is the target area that I drew last week, which is the end of that line right there. So we hit the target actually on Thursday and then open lower today on Friday the 7th. Again, staying right around that target and then rallying. Now, I'll erase these lines for the Russell 2000 and point something out for you here, which is, again, similar to what we just saw in the diamonds, where we have a smaller bodied candle within a larger red candle here. This too can be interpreted as a harami. So for the Russell 2000, I think we're going to move up, and I'm not talking about a powerful rally of any kind. I'm just talking about a slight move up to test this resistance area up here, and I'll leave that line up next week so that we can see how that played out. And then same thing like the diamonds, I think we're going to move right back down. So more or less oscillate within this trading range right here. The key point that you have to watch for is whether or not next week we close below that 20-period moving average. If we close below that blue line right there, then it means that the short-term trend is starting to reverse and go lower. So longer term, I'm bearish. Shorter term, I think we're going to rally just a little bit and then pull back. So it'll be a mixed week next week, and we'll have to see how that plays out. So that's the Russell 2000. If you look at the spiders, which is the S&P 500, again, right in line with what I said. I said earlier in the week we're going to rally to test that 20-period moving average. Zoom in a little bit more. Look at what I did. For those who watched my report last week, I drew this red line forecasting the 20-period moving average as well. Remember, last Friday, this blue line was not here. So I drew that as an extension of that 20-period moving average, and I said that's what it's probably going to look like. And then I forecasted that the market would move up early in the week to test that. Look at that, right to the penny, and then right back down to my target level. So this is quite amazing, and I'd love to take credit for this, but it's really not me. It's the charts giving us the signals on what's going to happen and what the big money is doing. If you really want to make money in the market, all you have to do is learn how to follow the money trail. And that's what technical analysis does for us as a forecasting tool. It helps us analyze where the money is flowing. So let me erase all my lines here, and I'll redraw again what I think is going to happen for next week. Again, this is the forecast, just like I do. I erase the lines. I think this moving average is going to continue lower. I really think that this is a pivot point here. You see that moving average rolling over. So I think the spiders, which is the S&P 500, is going to go and hug that line once again, more or less a repeat of what we saw this week before going lower right there. And so if you have any long positions that you're holding, the best recommendation that I could make for you is to protect your money with stop loss orders. Make sure you're ready to move out in cash if the market starts to roll over. Don't try to hold on and be a hero, because that'll exhaust all your profits and buying power at that point, and then you will not be able to participate in any down market after the market is pulled back and found a support level. You won't have any money to go buy into that new low area. That's why we encourage our followers to protect themselves with good risk management principles. I'll give you a link to where you can go to learn more about the 1% rule that we promote, a simple math formula that'll help you protect your money. And that's the way we look at the market. So that's the spiders. Now, if you look at the Qs, which represents the Nasdaq market, these are also known as the power shares. This too followed along with my forecast, and I want to draw your attention down to the bottom of the chart here. You see where my cursor is. Last week I said that there was an increase in volume on the way down, you see, as the price was going down, which showed us that the sellers were in control. And then what happened is the volume is now dropping, and that tells us that the sellers are losing control. You follow that? That this is a price volume correlation that we're looking at. So if I erase these lines up here, I'm going to leave my lines down at the bottom intact. But if I erase these lines, I'm going to draw my new lines for you here, and then we'll extend it out for you so you can get a good idea of this. So the drop in volume on the way down tells us that the sellers are losing momentum, and that's the first thing that the buyers look for. So I think with the Qs, we'll see a little bit of a rally and a test of the 20-period moving average. I'll draw that out again. I think it's going to look somewhat like that. And then I think we're going to pull back from that moving average, because it looks to me like the Qs are rolling over. That's the term that's used on the trading floor. When the trend starts to roll over, it's reversing. So keep an eye on that. Now finally, the VIX. This is ticker symbol VIX. It's a volatility index. My forecast here, again, 100% accurate. I said that we would pull back first. Look at my zigzag. This is week after week what I said we were going to do. I've left my lines, and I'm going to continue to leave my lines on this one. 3 weeks ago, I said we pulled lower, and that's exactly what happened. Week before last, I said we go up. Last week, I said we go down and then bounce. That's exactly what's happened. So what I think we're going to do is leave this line intact. I think the VIX is eventually going to rally, with the end of that line being my target price. Now remember, the volatility index is inversely related to the S&P 500. So if the VIX starts moving up, that is a bearish sign for the S&P. And we already talked about how short-term it'll rally and then it'll pull back. So this is what we're expecting, and the VIX supports that idea with an eventual pullback or rolling over that trend. If you'd like to learn more about the Market Guys and what we do, just go to themarketguys.com, click on the video tab right there. See that? The video tab will bring you to a library of videos that we call Market Shots. And if you scroll down towards the middle of the page, you'll see the 1% rule right there. See the 1% rule for managing risk. It's a very short 7-minute video. Click on that at your leisure. Learn it, understand it, apply it. It's a simple math formula that could really save you a lot of money and profits along the way. It's just knowing when to get out and how to manage the risk. And that's where most people go wrong, is to hold on to their investments, and then before you know it, they're giving back all that profits on one bad trade. So you don't want to do that. Also, if you're interested in getting a free sample of my next trade alert, just send me an email. Just go right in and click on About and Contact. And you can find my email address right there. Just send me a quick message that you'd like to get a sample. I'll be more than happy to send you one sample. I'm not going to send you a whole month because we charge for that, and our subscribers are paying a monthly fee for that. But we're having a great response from our audience. We're having great results. Our percentage of accuracy is still the best in the world, and we want to teach you how to do the same. So have a great weekend, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.